I'm Pate Butler, and this is AutoPilot Your Wealth, the channel where we build wealth with rules instead of reactions. If you're new here, what I do is run a rules-based option system across a few real accounts, and I show you the actual trades. Today is a trade day. I'm setting up a brand new account from scratch, and I'm going to walk you through every step of it. I'm calling this one my cadet account. The whole point of it is to show you don't need a huge balance to run the system. You can do it on a smaller account. This episode is a little bit out of order from what I had planned. I meant to show you two of my bigger accounts first, the captain and first officer accounts, but the NASDAQ pulled back this week, and when the market gives me the setup I'm waiting for, I take it. So I made these trades on Tuesday, June 9th, and I wanted to get this video out while the trade is still fresh. The two other accounts are still coming soon. They're already invested, and I'll show you those next. The captain account is around $225,000 depending on the day, and it runs on a QQQ barbell. The first officer account is around $170,000 and it runs on a SPY barbell. The cadet you're watching today is the small one, and it's going to run a 50-50 barbell using QQQM. Now let me explain why I'm using QQQM. I'm not picking it because it tracks the NASDAQ 100. I'm picking it because of the options. The barbell needs LEAPS, long-dated call options that go out more than 2 years. QQQM gives me that at a small contract size. As I'm recording this, I can buy a QQQM contract dated all the way out to December of 2028. When I look at a smaller SPY-based account like SPYM, which I'd actually love to use, the contracts just don't go out far enough. I won't hold an option once it gets inside a year, so SPYM is out for me, even though I like the fun. The big names like SPY and QQQ have plenty of duration, but those contracts run around $17,000 a piece. QQQM lets a smaller account get in the door. One more thing on the timing. The reason I'm finally rotating this account out of SPY and into QQQM is that the NASDAQ 100 had been overbought. I wasn't trying to time a top. I was already invested in SPY, which is the S&P 500. So I was in the market either way. I just waited for a pullback into the Keltner channel before I made the switch. And this week, I finally got it. I'll show you that chart at the desk too. Also, at the very end of this video, I will run a question and answer block at the end. So if you've ever wondered why I don't sell covered calls on these positions, or if you should be buying into a market this extended, stick around because that is all at the end. There are also some links in the description down below that back up today's setup. One is my SPY versus QQQ comparison, and the other is the QQQ barbell episode where I walk through why I run these at 50-50. Go watch those if you want the deep reasoning. All right, let me get to the desk. SPY is extremely liquid, maybe just a few pennies between the bid and ask spread on the ETF. So I'll just enter a market order and sell all 44 shares. And we're filled right there around $732. Now I've got the cash to work with, and I'm going to split it into two sides of the barbell. Okay, before I start buying anything, let me show you the math, because this is the part that seems more complicated than it actually is. The barbell has two sides. One side is the growth engine, the long-dated call options, the LEAPS. The other side is the ballast, Treasury bonds. For this account, I'm running at 50-50. So I take the account value right around $41,000 and I split it down the middle. Roughly $21,000 and change goes to the option side and the other half goes to the bond side. That's the whole idea. Half of it goes to leveraged upside and half of it goes to stability. Options come in whole contracts. You can't buy half a contract. So when I split a small account like this, I'm almost never going to land exactly on 50-50 to the dollar. I get as close as the contract sizes let me, and then the bond side picks up whatever's left. As long as I get close enough, then that's good enough. The other question is which option I buy. Here's how I think about strike selection. I'm looking for a window, not a single perfect strike. The window runs from roughly at the money down to about 20% in the money. Anywhere in the band works. Deeper in the money behaves a little bit more like stock and has historically carried a slightly better long-run growth rate. Closer to the money gives you more leverage but more time decay to overcome. 10% in the money is my sweet spot, the middle of that band, and that's what I aim for. But, and this is the most important part, I am not obsessing over hitting exactly 10%. Getting the money invested matters far more than sweating 20 or 30 basis points on the strike, especially on a small account where the available strikes are spaced out and you take what fits. So I'm aiming for that window, and I'm not going to agonize over the exact number. If you want the deep dive on strike selection, it's in my foundational flight plan playlist. I walk through the whole logic there. For today, just know I'm aiming for at the money to 20% in the money with 10% as the target. Let me go back to the desk and actually pick the contract. All right, right here we have QQQM on the daily chart with the RSI plotted at the bottom. And you can see around April 14th, the RSI goes into overbought territory. And I was just looking for a pullback. I could have probably traded here, it looks like May 19th, but I just was busy. I didn't get a chance to go in. So we got a pullback here on the last couple trading days. Now this chart is as of June 12th when I'm recording this. And we can see here on June 9th, I got the pullback I was looking for and I'm ready to execute my trade. All right, now move over to the option side. We're looking for a 50-50 split, and I have about $20,000 plus that I'm going to invest, right? So I'll go out to the furthest option, which is December 15, 2028. Right now, QQQM is trading at around the 288 level. So I go 288 times 0.9, that gives me 259. So 259 strike would be 10% in the money, and I have a 260 strike, which is pretty close. So I have about $20,000 to place into the trade, and you can see that 260 strike is between 76.75 and 78.5, which means one contract is trading between $7,675 and $7,850. So if I take my $20,500 and divide it by 3, I get 6,833. So I'm looking for something around the contract of $6,833. So the 275 strike is about 5% in the money, and you can see it's trading between 67.75 and 69.50. So I'll place my trade there to get my full option sleeve invested. So I make the trade, I set the limit at 68.75. And if you look at the order window, I actually was filled at 68.52. I got filled a hair better than my limit. 3 contracts, around $20,500 deployed, and the option side of the barbell is completed. Now the other half of the barbell, the bond side. Let me give you the rules first, and then I'll show you exactly why I'm buying what I'm buying today. Here are my rules for the Treasury sleeve. They're simple on purpose. Rule 1, I look at the yield curve, specifically the 3-month Treasury versus the 10-year. If the 10-year is higher, the curve is normal and I hold the intermediate Treasury IEF. If the curve is inverted, where the 3-month is paying more than the 10-year, I step down to a short-term SGov and wait it out. Rule 2, I watch the Fed. If I'm holding IEF and the Fed has started hiking rates very hard, 100 basis points or more inside of the last 90 days, I move to the short end, SGov, until that settles. Rapid hikes are what damage bond prices, so I get out of the way. Rule 3, to rotate from SGov back into IEF, I need both signals quiet at the same time. The curve must be normal again, and the 3-month yield can't have jumped more than 100 basis points over the trailing 3 months. Either one of them still hot, and I stay in SGov. That's it, curve and Fed. Let me show you both live. And here's the official source straight from the Treasury. Yesterday's numbers, 3-month is 3.78 and the 10-year is about 4.45. The 10-year is higher than the 3-month, so that's a normal curve. It's not inverted, so the rule says IEF. And the Fed, the big hiking spree was back in 2022. Since then, it's been flat and then cutting. The rate's been sitting around 3.75, and the recent moves have been cuts, not hikes. So nothing close to a 100 basis point hike in the last 90 days. So rule 2 is clear also. So both signals agree, normal curve, no rate shock. So I'm going to buy IEF for the bond sleeve. So now that I've decided to buy IEF, I'll go to my account, place the trade for IEF for the remaining balance. Filled at around 93.7. If we look at the positions in the account, I have 219 shares with an average cost of 93.78 and 3 QQQM contracts at the 275 strike filled at 68.53. And that's the account. That's the whole thing. I sold SPY, I bought 3 QQQM LEAPS for the growth side, and I bought IEF for the bond side. The cadet account is now a 50-50 barbell, and I'm done. There's nothing else to do. Let's think about this for a second because people expect this to be more complicated than it is. From here, this account mostly just sits. If I add money to it down the road, I don't go buy another option on a random day. I add it to the IEF side and I let the bond sleeve carry it until it's time to roll the contracts forward. I only make these trades once a year. And I want to say something to anyone who found today intimidating because options look daunting the first time. You pull up the chain, you see the strikes, the expirations, all those numbers, and none of it makes sense yet. That's normal. It's like anything you do for the first time. The first time is hard. The second time it's easier. And by the third or fourth time, you're doing it without even thinking about it. In the past, I've compared it to a pilot taking the runway for the very first time. All those lights look like chaos, a wall of color you can't read, but by the third or fourth time, the lights come into focus, you see the runway for what it is, and you know exactly what to do every time you get there. This is the same. It looks like a lot right now. It won't for long. Once you can actually read what you're looking at, this is a simple, safe way to invest. It's backed by data and back testing, not vibes. The mechanics look scary. The strategy underneath them is calm. And one more thing if you want to build confidence before you risk even a single dollar. Platforms like Schwab's Thinkorswim let you paper trade. You can run this with fake money for a while, get comfortable with the chain, place a few practice orders and watch them how they behave. By the time you do it for real, it's the fourth or fifth time, not the first. All right, let me do some questions. These are the ones I get over and over, and going forward, when I see the same question or the same confusion show up in the comments, I'm going to save it and answer it in episodes like this one. So if you got a question, drop it below. I'm watching. Question 1, why don't you sell covered calls on these positions? Free income, right? Well, that's because it caps the exact reason I'm here for. The whole reason I own LEAPS is the convexity. The way the gains accelerate when the market runs. When you sell a call on top of your position, you cap your upside in exchange for a little premium. You're selling the most valuable part of this strategy for pocket change. In a strong up year, that capped upside costs you far more than the premium you'll ever pay. I'll take the full upside. Question 2, okay then why not a poor man's covered call, selling short-term calls against your LEAPS? Well, that's the same answer with extra moving parts. A poor man's covered call still caps your upside. And now you've added a short option you have to manage, roll, or babysit so it doesn't get assigned or blow up on a fast move. My whole system is built to be low touch, rules driven. Bolting an active short call overlay onto it adds work and caps the upside. It's the opposite of what I'm doing. Question 3, why don't you trade TLT for the bond side? Because TLT is long duration. It holds 20-year plus treasuries, and that makes it extremely sensitive to interest rate moves. It swings hard. I don't want my ballast behaving like a second risk engine. IEF sits in the intermediate part of the curve and gives me the stability I actually want from the bond sleeve. And SGov is my short end hideout when the rules say get defensive. TLT has more volatility than this sleeve is supposed to have. Question 4, isn't this SGov versus IEF rotation just you trying to time the bond market? I get this one and I understand why it looks that way, but no. There's a real difference between timing and responding, and it matters. Market timing is prediction. It's me saying I think rates are going to go do X, so I'm positioning for it. I don't do that. I'm not forecasting anything. What I'm doing is reading what the market is already telling me. The yield curve isn't my opinion about the future. It's the market's own pricing, sitting right there in plain numbers. When the curve inverts or the Fed is hiking 100 basis points or more in a quarter, that's not me guessing. That's the environment already changed on the record. And the response is just basic duration management. In a rising rate environment, short duration takes less damage. When things settle out, you extend back out. That's not a crystal ball, that's reading the weather and deciding whether to bring a jacket. Any educated bond ETF holder does some version of this. I've back-tested this exact rotation rule all the way back to 1957 and it came out ahead. It's a tested mechanical rule with decades of history behind it. And think about the name of this channel, AutoPilot Your Wealth. AutoPilot doesn't mean hands off. It never has. It means you follow a consistent set of rules and checklists to manage your accounts, the same way I fly. I can't time the exact bottom in the bond market any more than you can call the exact bottom in stocks. Nobody can. But when you see momentum shift, you respond with a rule, the same way you'd respond to the stock market. The bond market is no different. So yeah, I may give up a little nav here and there at the edges. The rule keeps me in the game and keeps me out of the worst of it. And to be crystal clear, I am not telling you to go time the bond market. I'm telling you to have a rule instead of a feeling. Question 5, do you have to run this strategy starting in January? No, there's no magic about January. Today is June 12th. I made this trade on Tuesday the 9th, and that's perfectly fine. What matters is that you pick a consistent rhythm and you stick to it. not which month you start. You can rebalance in January, you can rebalance in June. You just want to be consistent year to year so you're not making it up as you go. Pick your date, run your schedule. Question 6. The market feels really extended right now. Should I even be investing or wait for a pullback? This is the big one, and I want to give you the real data, not my opinion. Vanguard studied this. In their 2012 study across the US, UK, and Australian markets, they found that investing a lump sum right away beat dollar cost averaging in at about 2/3 of the time. In the US specifically, lump sum won in about 68% of the rolling 10-year periods they looked at. Then Vanguard updated the work in 2023 looking at data from 1976 through 2022, and they found the same thing, lump sum winning somewhere in the neighborhood of 62 to 74% of the time, depending on how long you stretch the averaging out. 2 studies, 11 years apart with the same exact conclusion. The reason is boring and true. Markets go up more often than they go down, so money in sooner wins more often than not. So here's how I'd think about it. If you're starting from cash and you're nervous, you've got options. If you're just buying an index, you can dollar cost average in to ease the nerves. If you're building a barbell, you can park the money in a plain ETF first and then convert it on a pullback, which is exactly what I did for this account. I sat in SPY and waited for the QQQM dip. But understand the real lesson. When you're going from not invested to invested, there is almost never a perfect, balanced moment. You can wait forever for a setup that never comes. I waited for this QQQM pullback and it worked out. But it could just as easily have run another 90 days and cost me 10% of upside while I sat there on my hands. Nobody knows. So my bias is to get in, and with the barbell especially, being in matters more than the entry price, because if it does fall apart, you rebalance and you come back in stronger. That's the convexity working for you. Well, that's the cadet account set up and running. If you got questions about anything you saw today, the strike selection, the bond rules, the barbell, drop them in the comments. I read them, and the good ones end up in a future episode like this. The captain and first officer accounts are coming soon. If you're not subscribed to this channel yet, please do so. And if you find this useful, hit the like button so more people find it. Stay disciplined, stay patient, and I'll see you on the next flight.